Now let's review the solution to this problem. Remember that in this problem, on August the 1st, in the year X3, a company is borrowing $10 million of cash from the public through the issuance of bonds that mature in 3 years and bear interest at a rate of 9% annually. The interest is payable quarterly, so even though we calculate interest at 9% annually, we'll divide that into 4 parts because it's actually paid on a quarterly basis. The problem then first asked us to prepare the entries, the journal entry or adjusting entries required at a variety of dates. For example, on the date of the actual issuance of the bonds. At that time, we'll be debiting cash, or at least the business will. We're accounting for it from their perspective. Debiting cash and crediting bonds payable. Then 3 months later, on November 1st, the first quarterly interest payment is due. We'll have a credit to cash and a debit to interest expense for those 3 months worth of interest. The calculation of interest is $10 million times 9% for 3 months of a year, or 3/12. $225,000 is the amount of the credit and debit. Then we do need to make an adjusting entry 2 months later because we will have incurred an additional 2 months worth of interest cost, but it is not yet paid, so it is payable. The calculation of this adjusting entry, again, assuming we're going to prepare financial statements at the end of this calendar year, would be to calculate the interest at $10 million times 9% for 2 months, or 2/12 of a year, or $150,000 credit interest payable and debit interest expense. And then 1 month later, on February 1st, the next quarterly payment is actually due, where we'd credit cash for $225,000 and be debiting interest, but some of this interest has already been recorded as an expense in the year X3, and therefore we will be debiting interest payable for the previously recorded obligation for $150,000 worth of this 3 months worth of interest. The remaining $75,000 represents interest for the 1 month in X4 for January. Then it asks us for the entry at maturity, which is August 1st, X6. The payment at maturity can be made in either 1 or 2 entries. I'm combining them here, but you are going to have a credit to cash for the full amount of principal under the bond, which is $10 million, plus the last quarterly interest payment due at maturity, which is $225,000. The debit is to the mortgage payable for $10 million and also to interest expense for the last 3 months' worth of interest cost. The second part of this problem asks, what entry would the company make on their books if a bondholder owning $10,000 worth of the bond sold that bond to an investor through the New York Bond Exchange at a price of $10,500? The answer is the company will make no entry on their books because they don't participate in that transaction. It's an independent transaction by the investor with a new investor of which this company has no participation. Another good question here would have been to ask you why, in fact, would the bond sell at a higher price? The answer to that would have been that apparently interest rates in the general market had decreased such that the interest rate that we're paying at 9% on this bond is now more attractive, and therefore the bond is worth more. Finally, some of the important defined terms relative to bonds is, what is a debenture? A debenture is an unsecured bond. What is a mortgage bond? A mortgage bond is a bond that has real estate set aside as security or provided as a mortgage on the bond. What is a junk bond? A junk bond is an unsecured bond made to a business that really doesn't have a high credit rating, and therefore the possibilities of repayment might be somewhat questionable. They typically bear a higher interest rate. What is a serial as opposed to a term bond? In this particular case, we're talking about maturities. A serial bond is a bond where the principal amount actually matures over a series of dates or periods of time, as opposed to a term bond in which the entire principal amount of the bond is paid at the end maturity. What is a convertible bond? A convertible bond is a bond that can be converted to other forms of investment security. What is a callable bond? A callable bond is a bond in which the company that's issued the bonds and has the obligation can pay off those bonds earlier than the maturity date at their discretion.